To all of you. On behalf of Auditing and Assurance Standards Board of Institute of Chartered Accountant of India, I welcome you all in today's 171st CP program organized by AASB of ICI for this year. In the form of webinar, we have organized many webinars on the various key audit considerations. Today, we are going to organize on financial controls over financial reporting. And in order to tackle this very important topic, we are having with us CA Sonika Barmanji. So on behalf of AASB of ICI, I extend warm welcome to Madam Sonika Barmanji on this AASB webinar. Welcome to you, ma'am. Namaste. I also welcome today's moderator, CA Paras Chaddaji, on this AASB platform. Welcome to you, Parasji, for giving your kind consent to moderate today's webinar.
Thank you,
so
sir.
On Chairman sir and Vice Chairman sir both are stuck up in another meeting. So I'm taking this liberty to start today's webinar. And I request Parasji to please start the proceedings of today's webinar. Over to you, Parasji, please.
Sure, sir. Good afternoon, everyone. It's a pleasure to welcome you all to this extremely important session on internal financial controls over financial reporting. Today's session is designed to provide you with practical insights, best practices, and actionable key takeaways related to internal financial controls over financial reporting. This topic is so important because it involves regulatory requirements under various sections of Companies Act 2013. So if you talk about section 134, subsection 5, it fixes the director's responsibilities, right? Which states that directors in case of listed company have laid down internal financial controls to be followed by the company, and that such controls are adequate and operating effectively. If you read section 177, it says that audit committee may call for comments of auditors about internal control systems before their submission to board, and may also discuss any related issues with internal and statutory auditors and the management of the company. Similarly, if you read section 143 subsection 3 of Companies Act 2013, it says that auditors report should also state whether the company has adequate financial controls with reference to financial statements in place and the operating effectiveness of such controls. If you read Companies Accounts Rules 2014, there is Rule 8, which states that, or which requires that the board of directors report of all companies to state the details in respect of adequacy of internal financial controls with reference to the financial statements. So to discuss this topic in great detail, we have Sonika Barmanji. So please allow me to introduce her. Sonika Barman is a partner with Pricewaterhouse and has spent over 19 years in the firm. She has extensive experience in auditing and financial reporting under Ind AS, IFRS, SOX, etc. She has catered to clients both listed and unlisted in different industries, including technology, retail and consumer, logistics, industrial products, education, etc. She has played a key role in driving transformations and innovation in audit. She believes in building a cohesive and inclusive work culture, delivering sustained outcomes, embracing innovation, and solving important problems. She is a member of Institute of Chartered Accountants of India. And if we talk about her hobbies, she loves watching cricket and tennis and likes to travel. Now, without further ado, I think we should start our technical session. I welcome you, Sonika ji, and hand it over to you.
Thank you, Paras. Thank you, Anil ji. Good afternoon, everyone. Maybe I'll just put up my presentation. Anil ji, you can see my presentation, right?
Yes, madam. Yes, madam.
Okay. Thank you. Maybe Paras has outlined as to what we are going to cover in today's session. That is on internal financial controls over financial reporting. So this is, you must be wondering that this is not a new topic. It has been there for so many years. But, even today, we are, when we audit companies, we are learning every day on this particular topic. So this is, always welcome to refresh our knowledge on this particular topic. We will be covering some examples also. And, It's a very heavy topic, because if you've read the guidance note, it is divided into multiple parts. So I have also divided my presentation into four parts, and maybe after every part I will take a pause of a couple of minutes for you to absorb what has been covered in the presentation. On questions, I discussed with Paras, we will take the questions at the end. So, as we go along, whatever questions that you have, please park your thoughts and keep sharing. And then, at the end, we will have a question answer round. So, with that, I will start with the session. So, on the first part, I will cover overview of what is the expectation, what is there in the guidance note. Then it is basically the planning of an audit of internal financial controls. I will cover that. There will be aspects of assumed risk of material misstatement versus specific risks, which I will cover. And I will also in this section cover about the entity level controls and the process level controls. So, on the overview, as you are all aware, the reporting framework for auditors, as outlined by the guidance note on audit of IFCFR, says that auditors need to obtain reasonable assurance to state whether an adequate internal financial controls system exists. And as part of that, the auditors are required to comment that internal financial control system operates effectively in the company with respect to financial reporting only, right? And for that purpose, auditors are required to adopt SA 315, which is identifying and assessing the risk of material misstatement through understanding the entity and its environment as a framework. As far as standards on auditing are concerned, those do not fully address requirements of reporting on IFCFR. So one needs to refer to the guidance note. And we will, in the next few slides, we will cover that, what is covered in the guidance note. But once you read the guidance note, it provides supplementary procedures. There are a lot of examples, situations, implementation guide, etc. on IFC. And thus, besides the auditing standard, one needs to refer the guidance note for exhaustive information on the IFC requirements. One important element in that guidance note states that the auditors should report on design and operating effectiveness as at balance sheet date. So what it means is that testing needs to be done throughout the period. So, there are a lot of questions which come that, if a company remediates everything at the year end, only does that serve the purpose? Answer may be no, because there may be a lot of controls which are maybe monthly controls, quarterly controls, daily controls, etc., which only if they are exercised at the year end do not serve the purpose. So accordingly the expectation is that auditors should look at design and operating effectiveness throughout the year, which is the period covered by the audit. And as Paras mentioned, that there is a responsibility of directors of the company to comment on internal financial controls. And for that, management is required to give that comfort to the directors of the company to be able to take that responsibility. However, as auditors, we are not required to report on the assertion of the management, but we are required to give independent assessment and provide a distinct opinion on the internal financial controls over financial reporting. This is a typical flow of an audit of internal financial controls over financial reporting. It looks like a busy slide, but it's very, very important to understand from a flow of this audit. So, the starting point is identifying significant account balances and disclosure items. Because from an audit perspective, materiality considerations apply not only on audit of substantive testing, but also on IFCFR audits, because we are not required to cover everything in an audit. Accordingly, it's important to identify significant account balances and disclosure items. Then one needs to identify and understand the flow of transactions. So how does one do that is by obtaining the statement of operating procedure, risk control matrices which are available with the management. So accordingly, one needs to identify the flow of transactions. Then in that risk control matrices, there will be risk of material misstatements. That is basically what can go wrong in a particular process. That is very important to understand. Once the risk of material misstatements are identified, then one needs to identify the controls which will address the risk of material misstatement. The controls again can be of two types. Controls can be either automated or they can be manual. Automated controls, for that purpose, one will have to understand, what are the IT applications being used by a company, and basically in that, which are the financially relevant applications. And for the purposes of relying on the automated controls, one will have to understand the IT general controls, and we will come to that in detail in the subsequent slides. So this is basically, the starting of an audit of internal financial controls. Once you have done that, then it comes to, evaluating the design. So a design evaluation, in a normal parlance, we call it walkthroughs. So how do you perform walkthroughs? Walkthroughs can be performed by, picking up one sample and running it from start to finish by validating a particular evidence. So, basis, performance of walkthroughs, one will be able to evaluate design. That is whether the design of controls is adequate in a particular cycle. Once we are comfortable with design of the controls, then we will perform the operating effectiveness testing of controls. And for that purposes, one will have to understand that what is the frequency of controls and what is the risk basically of the controls. Because I'll give you an example that, for example, if it is, revenue, so not necessarily that everything in revenue is a high risk. There can be things in the revenue cycle which can be even low risk or moderate risk. But for example, a risk of fraud in revenue recognition is a high risk. So depending upon the risk and the frequency of the control, one will select sample and perform the operating effectiveness testing of the controls. Then once you have been able to do that, then we will have to accordingly evaluate all the findings and then conclude on the testing, right? And once conclusion is done, then the question comes on forming an opinion on internal financial controls, right? That also does not bring it to an end, because after one has done the internal financial controls conclusion and summarization of the opinion, then one needs to consider the impact of that on the financial statement audit. Because nothing is done in isolation. So for example, if there is a material weakness that one identifies in our internal financial controls, then one will have to evaluate the impact on the financial statement audit. One cannot say that material weakness is a isolated weakness and it will not have an impact on the financial statement audit. So this is a very important flow chart which I wanted to bring to all of you. It's a very, very useful flowchart, and one will have to keep this in mind in all audits of internal financial controls over financial reporting. Now we will come to the details that basically, whatever I have covered in this particular flowchart, I will cover it in detail in the subsequent slides. So the first part is on planning. So a very important element of planning is that the financial statement audit and the audit of internal financial controls opinion, though the objectives are not the same, but basically, they go hand in hand. So, in common parlance, what we do is that we say that, we do not perform the audits in isolation. Whenever, as auditors, you have to plan the audit of financial statements and IFCFR, we have to accordingly, look at accomplishing both objectives. And what we need to consider is performing a risk-based approach, and also use a top-down approach. So by way of risk-based approach, what I mean is that, it does not mean that one size fit all. Like, for example, if it's a smaller, less complex company vis-a-vis a large company, the objectives that, both the companies are trying to achieve is very, very different, right? So from that perspective, our approach of IFCFR audit will also differ. I will explain this by way of this particular diagram. So, top-down risk-based approach to planning means that we have to first start by, starting from the financial statement level, and we have to understand the overall risks to the internal controls over financial reporting. Then we have to come to the entity level controls. Entity level controls also I will cover in detail in the subsequent slides. So I'm just touching upon here in this diagram, and we can cover that in detail in the subsequent slides. After understanding and evaluating the entity level controls, one will have to understand the significant accounts and their relevant assertions, because all assertions are not going to be relevant for all accounts, right? And assertions understanding is very, very important, because the audit of financial statements and internal controls over financial reporting will depend upon the relevant assertions. Once we have done that, then one will have to understand the risks. Basically, what can go wrong in that particular cycle. And then once we have understood the risks, then we will have to understand which controls will address that risk, right? And it is not that all controls needs to be tested. Like, for example, if there is a assertion which is completeness, and there is one risk, so we will have to assess that which control is most important to address that completeness assertion and to mitigate that risk. If suppose five controls are addressing the same risk and same assertion, we have to understand that which control is the most important and accordingly test that control. In common parlance, we call it key control, because if there are suppose 500 controls in a particular cycle, it does not mean that we have to test 500 controls. We have to identify key controls, and when we say we, it applies to both auditors and also management while they are doing their management testing. So very important to understand the assertions, very important to understand the risks in the cycle, which controls address the risk, and which are the key controls. So this is what it is called a top-down risk-based approach to planning and audit of internal financial controls over financial reporting. Now, whatever we have covered in the previous slide, we will cover that in a bit more detail by way of 5 steps. So we call it 5 steps in planning. The first one is identification of significant account balances and their relevant assertions. So, as I said in the previous slide, the purpose of a financial statement audit and IFCFR audit are not delinked. So, the purpose is kind of, to achieve a combined audit. So, one should consider the materiality considerations which apply to both these audits, and the materiality considerations are same for both the audits. So we cannot say that materiality consideration for financial statement audit is separate and that for IFCFR audit is separate. The second element is qualitative considerations. So, as I said, risk factors, relevant assertions are also same for financial statement audit and IFCFR audit. So, for example, for a revenue and receivable cycle, the relevant assertions are completeness, accuracy, cutoff, valuation, occurrence, existence. These we cannot say that are different for a financial statement audit and different for a IFCFR audit. So it is very correct to conclude that significant accounts and disclosures are same for financial statement and IFCFR audit. Having said that, if there is a multi-location audit, then the risk assessment will be based on particular location or business unit. So it cannot be that it risk assessment is done the same for all locations in a multi-location audit. The second step is identifying and understanding the flow of transactions. So for that purposes, one needs to obtain the what we call a SOP, the statement of operating procedure, and a risk control matrix, and plan for a walkthrough, because basis a walkthrough, that is design evaluation, one picks up one particular sample, and then from start to finish we run in the entire process, and accordingly obtain understanding of the flow of transactions in that process, right? And in this activity, as it is very very important, it is very it is a good practice, rather it is very important for senior team members to get involved in this particular activity, because it's a very very critical activity in IFCFR audit, both in terms of auditors and in terms of management and their management's testing. And in this activity, one also obtains understanding of the relevant applications, that is all the information systems, because all applications are, there may be many applications used, but what are the relevant applications is also obtained, understanding is obtained by way of this particular step. Then step three is, as I said, on the left hand side, identifying the risk of material misstatement, because every risk is does not lead to a risk of material misstatement. So accordingly, in this cycle, one understands that how is a transaction initiated, authorized, processed, recorded, and one considers what we call as what could go wrong, basically, right? So accordingly, in this particular process, one also identifies misstatements which can be due to errors or fraud. And as part of this step, one should consider control deficiencies, which are previously communicated by auditors, whether external auditors, internal auditors, or companies can also get any special audits done. So deficiencies should be considered, from those audits also, to be able to ensure that we have a complete understanding of the risk of material mistake. Then, once we have identified the risk of material misstatement, then step four is identifying controls which address the risk of material misstatement, because the endeavor is to bring those risks to a controllable level, right? So there can be risk of material misstatement. Like for example, there can be a risk that revenue may not be recognized in the correct period, but we will have to accordingly understand and evaluate control which addresses that risk and brings it down to a reasonable, controllable level, right? And what, as I said, that if, say, for cutoff, because revenue is recognized in the correct period, addresses the cutoff assertion, If there are maybe two controls which address the same cutoff assertion, then we will have to identify which one is a key control, and then accordingly perform walkthrough of that key control and test the control as well. We may not test both the controls, right? I briefly alluded to a terminology called entity level controls, in the beginning. Entity level controls are different from process level controls. Entity level controls, operate at above the process. And we will have to accordingly test entity level controls, which are more direct in nature and which will help us to reduce our testing of process level controls, right? In the subsequent slides, I will have few examples of which entity level controls am I talking about, and which ones should auditors consider for testing, right? Entity level controls are basically, controls which relate to the control environment. So, those do not operate at the transaction level. Those operate like, for example, a performance review is a entity level control, right? And a process level control, for example, is controls like, controls operating for, as I said, revenue and receivable cycle, procurement cycle, property, plant and equipment cycle, etc. Those are process level controls. So we will cover, entity level controls and business performance reviews in detail in the subsequent slides. Then step 5 as part of planning is identifying applications which are associated with IT environment and what we call IT general controls, because controls can be either manual or automated, or those can be IT dependent manual controls, right? But to be able to rely on automated controls or IT dependent controls, one needs to actually identify applications, IT applications which are relevant and which are financially significant, and also, which will be very important to test as part of our testing of internal financial controls, because all applications will not be financially significant, and accordingly it is very important to understand that, which are the financially significant applications, and then accordingly understand and evaluate IT general controls, which will then give us comfort that whether we have comfort on design of IT general controls, and then only we will perform testing of automated controls or IT dependent manual controls. Right. And then, a very quick summary on what are the contents in the guidance note on audit of IFCFR. As I mentioned in the slide one, was that although we are required to consider SA 315 in our audit of IFCFR, but we have to consider the contents of guidance note, because guidance note on audit of IFCFR is very, very exhaustive. There are many examples. It is divided into three parts. One, it gives a overview of the requirements of Companies Act, so on and so forth. There are detailed guidance. It is divided into 5 sections, and there is detailed guidance in Part B, and then it is accompanied by many appendices, and appendices include the illustrative risk of material misstatement related control objectives. There are templates for testing controls, etc. And so it is very, very important to consider the and read the guidance note to be able to do a qualitative audit of internal financial controls over financial reporting. The other element which I mentioned is likely sources of potential misstatement. In auditors' terminology, we call it in short form LSPMs, or what could go wrong. So we will have to understand that if a control fails, then what can go wrong as a result of that control failure, right? And this is very, very specific to a client situation, right? And it is very, very specific to a process in a client's environment. So it is not that one control objective can fulfill all clients. There can be a situation that it may fulfill more than one client, but generally it differs based on client specific factors in each process. It is very important to consider certain elements of guidance note with respect to LSPMs. For example, the para 100 of the guidance note says that for LSPMs, one needs to understand the flow of transactions. One needs to identify the points within the company's process at which a material misstatement could arise. So it's very important to understand this element. And once we have done that, then the guidance note says that you have to identify controls which actually address those potential material misstatements, right? So, and then identify controls that management has implemented to prevent or detect misappropriation. So these are elements of guidance note which one will have to consider. And guidance note para 96 says that auditors might determine the LSPMs by asking himself or herself that what could go wrong within a given significant account or disclosure. So, if while performing walkthroughs, if we actually, ask ourselves this important question, that if this is not addressed, what could go wrong, it may answer a lot of questions, right? So it's very important to keep asking ourselves this particular question while we are performing the audit of internal financial controls over financial reporting. And this is verbatim from the guidance note which I have pasted here. So it is not somebody's interpretation. So, accordingly, it's a very, very important consideration of audit of IFCFR. Now, entity level controls, I have been talking about that in the last 10 minutes. We will cover a bit more on entity level controls in the next few slides, along with few examples. So, what are entity level controls, or I will call them as ELCs? So, as I said briefly, these are related to control environment. For example, controls over management override can be called as entity level controls, right? Those may not necessarily operate at a transaction level, right? Like for example, controls by way of setting up policies and code of conduct, for example, or setting up a audit committee to overview audit function. Those are kind of entity level controls, and these are examples which are highlighted in the guidance note itself, right? So why does one needs to focus on entity level controls? Because entity level controls can help the auditors. Once auditors evaluate entity level controls, those can actually help in reducing the or increasing the testing of auditors of controls, right? So because basis the comfort that auditors derive from entity level controls, one can reduce the testing as well, or basis that whatever are observations of entity level controls that may actually make the auditors increase the testing of entity of other controls. So it's very important to accordingly evaluate ELCs. But does one need to evaluate all ELCs? Answer may be no. And why is that? Because ELCs are also of three types. So one is indirect ELCs. Indirect are those that do not themselves directly address risk of material misstatement at the account or assertion level, right? But are important to effective control. I will also give examples of each of these in the subsequent slides. So please, hold on to your thoughts in terms of what are indirect entity level controls. Then another category is direct that are not precise enough. This means that these directly address a risk of material misstatement at the account or assertion level, but are not precise enough on their own to fully address a risk of material misstatement. And third category is direct that are precise enough. So these, as you may guess from the previous two definitions, these are those that address a risk of material misstatement at the account or assertion level and are precise enough on their own to fully address the risk of material misstatement. So three categories. So indirect, which do not directly address the risk of material misstatement, but they are important to effective control. Direct are those which actually are addressing a risk of material misstatement, but they are not precise enough. And third category is direct and precise, right? So we will take each of these by way of examples because it will help us in understanding the difference because definitions are there in guidance note, but few examples which will help us understand each of these better. So if we take the first example, so first example is that assistant controller conducts an annual financial reporting conference attended by all subsidiary controllers to discuss new or revised corporate accounting policies due to changes in the business and changes in accounting principles, financial reporting risks associated with these changes, and activities necessary to respond to these new financial reporting objectives and related risks. So I will take a pause for 10 seconds for everybody to guess that what can be this type of entity level control. So this is a indirect ELC. And why is it a indirect ELC? Because these will not by themselves prevent or detect a material misstatement with respect to one or more relevant assertions, right? So that is the reason that it is an indirect ELC. It will not help an auditor to actually test this particular indirect ELC because that it will not directly address a risk of material misstatement or a relevant assertion. The second example on ELC is that management performs a trend analysis of revenue recognized during the year, current year versus previous year. Now, is this indirect ELC, direct, not precise, or direct and precise? So, answer is direct, not precise, because again, this is not performed at a very, very granular level, right? So, this is like a detailed analysis, not a detailed analysis performed. They are just performing an analysis. It is direct, but it is not at the precise level to be able to address a particular assertion, and accordingly it is a direct ELC and not precise, right? Third example is controller performs a variance analysis of rent expense to budget prepared at the beginning of the year based on lease premises, existing plus new proposed leases. Now, which category is this? This is direct and precise. And why is that? Because budget is a valid expectation that is not expected to materially change during the applicable reporting period, because they have accordingly considered existing plus new proposed leases, and accordingly we are concluding that it is a direct TLC which is precise as well. Although one can argue that budgets can also change, but if it is based on underlying data, more likely than not, a budget may not change. And accordingly, I am concluding that this is a direct TLC which is precise. There can be many more examples, but I thought that maybe it is useful to give an example of each of the three categories. And before we move on to the next section, basis these three categories, as I said, auditors and management in their testing should consider direct and those which are precise in testing, because those can help the auditor or management in reducing the testing of other process level controls. Although nobody is stopped from doing extra testing, but it is more important to do effective testing. And accordingly, the guidance note says that one should consider testing direct and precise level entity level controls, because those can accordingly help in achieving the necessary objectives of IFCFR audit. Maybe I will take a pause of 30 seconds before we move to the next section on IFCFR. So in this section, I will cover what we call BPRs. These are also part of entity level controls. We will briefly talk about review type controls. This is a very important section covered in the guidance note. We will cover a bit more in detail that how does one plan and perform the operating effectiveness testing of controls, and a very important element which is remediation testing, because generally what we have seen is there is a lot of ambiguity in terms of remediation testing, that when do we consider that sufficient remediation and adequate remediation is done. So we will cover that as well in on remediation testing. In terms of BPRs, so BPRs are also one type of entity level controls. These can be direct or indirect. So, direct, if these address a risk of material misstatement or a relevant assertion. And BPRs are basically, processes which are performed by management, which are directed at basically, determining whether the certain matrices are being met, which can be financial or non-financial. And BPRs can be designed, accordingly to actually prevent or detect misstatement that could arise when transaction level controls are missing or deficient. One needs to consider for precision of controls, because what we mentioned is that there was a category which was direct and precise. So for precision of controls, you may be thinking that what does one need to consider? So one needs to consider the purpose of the control, the level of aggregation, performance consistency, that how does it correlate to the relevant assertions, criteria for investigation, and predictability of expectations. So all of these or few of these are to be considered for determining whether a control is precise, right? So again, very important to consider that which type of BPRs should one test, because all BPRs may not be relevant for the purpose of audit of internal financial controls. Next category, very important, is review type controls. Review type controls, in the common parlance, is basically if somebody is performing something and somebody is reviewing something, right? So, in the guidance note says that those are controls whereby the control operator reviews certain information and takes other necessary action based on the results of the review, right? So, this is the definition in the guidance note. Examples can include review, for example, of journal entries, review of reconciliations, as simple as bank reconciliations, account receivable reconciliation, accounts payable reconciliation, uh, right? If somebody is reviewing some complex calculations, etc., there can be many such examples of review type controls. When one is evaluating the design of review type controls, then one needs to consider the quality of information, including reliability of the data, competency and skill of the control operator, that the person has to be competent and has to have the necessary skills, and completeness of the implementation, right? So basically what I'm trying to say is that uh, the auditor should assess the risk of with the review type control, whether it is performed by individuals or by group, basis the subjectivity and complexity of the controls, and then accordingly consider design and whether it is operating effectively. And what is important is that only a mere sign off is not enough for a review type control, right? So only if somebody has performed something and somebody has just signed that does not mean that a review type control is designed appropriately and is operating effectively. So one needs to consider that, if it is a very complex and subjective control, then what is the reviewer performing in that review type control? What are the assumptions which the reviewer is looking at, etc., and not mere a sign off, which is sufficient for a review type control of such nature. So one will have to consider that what is the purpose of the control, that what is the uh, likely source of potential misstatement that a control is trying to address, is very important to understand when one is evaluating design of a review control. One will have to understand exactly that how is the control, the reviewer exercising the control, that what all evidence is the reviewer examining, what all assumptions are they considering, etc., and to be able to take a comfort that how are they exactly operating as a reviewer is very important. The third element in a review type control, which one will have to consider, is what all information is being considered and what is the source of that information, right? Very important, because one will have to see that how is the reviewer ensuring that the information being considered is complete and is accurate, right? Then the fourth element which we will have to consider is that what is the evidence that the reviewer is considering, right? To be able to conclude that they are taking appropriate comfort on the control activity. And last but not the least, one will have to consider that whether the reviewer is competent and has the adequate skills of doing that review, right? So these will be very important considerations for us to be evaluating a design of review controls. So uh, very, this can be explained by way of an example. So here, in this example, I will not exactly read out the example, but I'll summarize for everybody. So here, the example which is there is that there's an assistant controller who is performing review of individual journal entries, which will include tying those out to supporting documentation. The controller is checking that debits and credits are, reconciling to appropriate accounts. He is ensuring that entry is for valid business purpose, right? And in accordance with the company's policies. And if there are no other items that require investigation, then the controller is authorizing the journal entry, right? So after the assistant controller is reviewing, the controller then scans the posted journal entries to ensure that again whether those are reasonable, in line with his understanding of the business, in line with underlying supports, etc. And on a sample basis, the controller reperforms procedures performed by the assistant controller and investigates entries that he deems to be unusual, right? So in this example, when we are evaluating design of a review control, then from a purpose perspective, what is the purpose? Purpose is to ensure that the journal entry approval control performed by the assistant controller is effective, right? On evidence, what is the evidence that the controller is seeing? The controller is trying to see that whether the entry is in line with understanding of business, it reconciles with supporting documentation, and on a sample basis, the controller is reviewing the entries and investigating certain entries which, as per him, seems to be unusual. What is the source? Source is basically list of all the entries which are posted and underlying support for the entries. And from a competency and skill perspective, we are assuming that the controller has the required competency and authority to be able to perform a effective review of the control performed by the assistant controller. Right. So here, then we conclude that this is like a effective and basically a review control which has been designed appropriately, right? So these are the important considerations which one has to consider while evaluating design of a review control. And the other important element is that one will have to consider the precision level at which the control operates, right? Coupled with the significance, sensitivity, etc., of the assumptions, which will impact the evidence, which one will have to consider for the purpose of the review controls. And precision is what we have already considered in the previous slides. So, a very important element thereafter. So, we have already covered, just to recap, the planning of an audit of IFCFR. We've covered some key elements of IFCFR audit, which are LSPM, that is what can go wrong, ELCs, BPRs, review controls, right? Now we will come to important element, which is operating effectiveness testing of review controls. We've already covered what is review controls. So in this section, we will cover about the ways and means of performing this particular testing. So there can be inquiry procedures that can be done. There can be observation, there can be inspection, and there can be reperformance. right? So inquiry can be that, asking the reviewer that, how is he or she performing the particular review? What all evidence are he or she considering? What all assumptions are he or she considering, etc., is part of inquiry procedures. Observation, like for example, the example that we took of controller performing review of work done by the assistant controller, we can sit down in that review and observe how is the controller exercising that particular review control, right? The other way is inspection. So once the controller has already done the review, then we can inspect documents and accordingly conclude whether the control is operating effectively, right? The fourth category is reperformance. So whatever the controller has already done, then we can accordingly pick up few samples and then thereafter reperform it ourselves, right? That can be another way of testing the operating effectiveness of review controls. Generally, the practice is perform inquiry and inspection procedures, because in many cases it is difficult to perform observation, and reperformance can be done of few critical review controls which are very very of subjective nature, etc. Like for example, valuation, impairment of investments, etc. There is where we can also perform reperformance of controls, but generally prevalent practice is to perform inquiry and observation procedures. The last category in this section is remediation testing. Now, what we mean by remediation testing is that if we have noted deficiencies in as part of our testing of design and operating effectiveness of IFCFR, and but does that mean that those cannot be remediated by the company? Answer to that is no. Those can be remediated, but there has to be sufficient remediation during the balance sheet date and during the period when audit report needs to be issued. We will better understand this by way of examples and cover conceptually a bit more in detail. Now, in this example, the auditor's control opinion is at the balance sheet date. And as we know, the auditor is required to test throughout the period, right? So management remediated exceptions before the period end, either by changing the design or implementing new controls, or both, right? So, or both cannot be considered in forming our opinion. So, exceptions, what we are trying to tell here is exceptions are to be remediated before the period end, either by changing design of existing controls or by implementing new controls, or both. So here, if those are done, like if management accordingly corrects the design, if there are design gaps, management can accordingly consider correcting the design gaps within the balance sheet date, or they can implement new controls, or they can do both. But it is very important to note that when new controls are implemented, for example, if it is a monthly control, it cannot be that it can be implemented only on 31st of March and we can be comfortable with the new control. It has to be implemented either or at least by January and operate effectively for February and March for us to be able to take comfort, if it's a monthly control. If it's a daily control, then again it has to be implemented for a sufficient period for us to be able to take comfort. One cannot say that it can be actually implemented only on 31st of March and it is sufficient remediation. Right? The second thing is that sufficient time should be available to evaluate, test the design, implementation, and operating effectiveness of controls as at balance sheet date. This is true because, as we have considered that this has been defined in the accordingly in the guidance note as well. And it is a matter of professional judgment that what is a sufficient time, because that is not mentioned in the guidance note, but it is a matter of professional judgment of the auditors. The third important question here, we have to think true or false. So, frequency of the operation of remediated control is irrelevant to determining sufficient time. So long as controls are remediated as at year end, even if immediately before year end, it is good enough. So, as I have already covered in the previous example, it is false because only if remediated at the year end is not good enough. It has to operate for a sufficient period for us to be able to say that control has been sufficiently remediated. Here, again, very important consideration. Samples for testing remediated controls may include instances subsequent to balance sheet, but before report signing date, where sufficient instances do not occur within the year end being opined on. So, this is absolutely false because we cannot consider instances subsequent to balance sheet date. So, for example, if we are doing audit of a company having financial year April to March, if management has remediated a control in April, we cannot consider that particular control. Even if we are performing control, maybe audit in September, that does not mean that we will consider controls remediated in April. We will have to consider remediation done within 31st of March to be able to take comfort on that remediation, right? And otherwise, we will not be able to consider. Where all interim control deficiency findings are remediated before the year end and adequate and appropriate testing can be performed, we may issue an unqualified opinion. Answer is true, right? So, because all remediation is done before the year end, there are testing also performed adequately. So, accordingly, we are in a position to issue an unqualified opinion. Now, some key considerations of evaluating remediated event-driven controls. The first one is we have to assess the design of the controls. That is, example is that do the individuals who are performing the control, whether they possess the required knowledge and competency to perform this duty. We will perform walkthroughs. That example is that whether they have adequate instructions which are communicated to the individuals who are performing the control. And we will assess the completeness of the implementation. That is, whether remediated controls have been fully implemented as of the year end and they are ready to be performed when the event occurs, right? So I will take a quick pause here. We have covered two important sections of internal financial controls. It is a bit heavy, but I have tried to cover all important elements of the guidance note along with the relevant examples, because at times what happens is that if we don't cover relevant examples, it becomes very theoretical. We have two more sections left, 3 and 4, which I will try to cover by 5:30, and then we will be able to take the questions. Maybe a 10 seconds pause, and then we can go to section 3. So, maybe you can summarize your thoughts on section 1 and 2 in case there are any questions. Now, in this section, we will cover how do we evaluate identified control deficiencies. We have spoken about IT implications. We will cover important elements of the shelf packages and relying on a service organization. To start with, evaluating deficiencies, again, sections of the guidance note. So, as per guidance note, it says that auditors must evaluate severity of each control deficiency, whether deficiency individually or in combination are significant deficiencies or material weaknesses. Why is it important? Because control deficiencies alone will not result in impacting the opinion on internal financial controls over financial reporting. Having said that, multiple control deficiencies can tantamount to a significant deficiency or a material weakness, and thereafter, those can have implications. Second important consideration, if one or more material weaknesses exist, the company's internal financial controls cannot be considered effective. Right? If auditor identifies deficiencies in controls design or operating effectively, auditor should take into consideration those deficiencies when developing, a response to risk of material misstatement during financial statement audit also, right? Because as I said in the beginning, both audits cannot be performed in isolation. So if we have noted a deficiency in controls audit, then we will have to consider that, if there can be a risk of material misstatement in the financial statement audit. It is very, very important to be considered. Now, types of control deficiencies, as our audit of IFC is divided into two parts. So even if control deficiencies are there, those are also divided into two parts. One is design deficiency. So design deficiency example is that a control did not exist, right? So there are missing controls in the cycle, or control is not designed appropriately, right? So either control does not exist or control is not designed appropriately. The second category is that there is a operating effectiveness deficiency. Right? And there are three categories, as I said: control deficiency, significant deficiency, and material weakness. Right? The auditor should modify opinion if deficiencies individually or in combination has been assessed as material weakness. Right? And for this, to be able to conclude on this, there are senior people who are required to evaluate. There are discussions to be performed between the auditor and the auditee, and a lot of deliberation to be performed before we can conclude on the modification of the IFC opinion. Now, test points to consider while testing design and implementation of controls. Very important considerations that well-designed controls can effectively prevent or detect error or fraud, because if controls are designed effectively, then it can prevent a risk of material misstatement, whether due to fraud or error. Design can be evaluated by mix of those procedures which we have discussed, which can be inquiry, observations, inspection. Inquiry alone cannot provide sufficient evidence. So we can, if we have already discussed, but only inquiry is not sufficient. Right? Then persons performing the control should possess necessary authority. Greater the inherent risk, the more precise the controls are expected to be, because if inherent risk is higher, we have to accordingly ensure that the controls are very, very precise. And we will also have to consider the segregation of duties, right? And alternative controls, because there can be a situation where there can be compensating controls or alternative controls which can be there to meet the control objectives. So we will have to accordingly consider those as well, right? Then audit impact to be assessed, and other procedures performed, for example, testing the compensating controls. So when we spoke about the alternative controls, so we will have to accordingly test those alternative controls also, right? So as to be able to take comfort that those are operating at the same level of precision and they address the same risk, because then only we can say that those are compensating controls. And it is very important to note that if we have noted that a design is not effective, then it doesn't make sense to assess the operating effectiveness of the control. Because if the design is only not effective, then why do we perform the operating effectiveness of the control? And an improperly designed control can indicate a material weakness or a significant deficiency, because that can result in a risk of material misstatement. Right? It is not that it will, but it can. So, accordingly, it is a very important consideration that one will have to consider improperly designed controls for evaluating whether they result in material weakness or significant deficiency. And a very important statement here, which says that inadequate documentation is a potential design deficiency, right? So if, like we call, in auditors terms, work not documented as work not done. So it's very, very important that adequate documentation is done so as to be able to say that there is no design deficiency. Now, auditor must evaluate severity of each control deficiency, whether it is a control deficiency, significant deficiency, or material weakness. But multiple control deficiencies that affect the same account balance increase the likelihood of material of misstatement and material weakness. As we have spoken in the previous slides, one will have to assess compensating controls, assess the aggregation risks of control deficiencies, because if there are more than one control deficiency which is impacting the same assertion and the same cycle, we will have to consider aggregation risk, and we will have to consider the impact of the summary of uncorrected misstatements as well, because if there are uncorrected misstatements in an audit, we will have to consider if those are indicating that there is a deficiency which exists in terms of controls. And a very important consideration is that a material weakness may exist even when the financial statements are not materially misstated, right? So it is not prudent to assume that if financial statements are not materially misstated, there can be no material weakness in internal financial controls. Now, factors to consider in determining severity, we should consider the likelihood, magnitude, we should consider qualitative considerations and compensating controls, because once we identify deficiencies, we have to see if there are any compensating controls which address the same risk and operate at the same level of precision, which can accordingly bring the level of risk of material misstatement under control. Some indicators of material weakness, identification of fraud, whether or not material on the part of senior management, is one indicator of material misstatement. Errors observed in previously issued financial statements in the current financial year. So, if we are auditing FY25 and we have noted during the audit that there were errors in the FY24 financial statements, then that can be an indication of material misstatement. Then identification by the auditor of a material misstatement in the financial statement audit in the current period can also indicate that there can be material weakness in the IFCFR audit. And if there are issues with ineffective oversight of the company's financial reporting and IFC by the company's audit committee, that can be again one of the indications that there can be issues with material weakness. There are some considerations for determining whether there are any pervasive deficiencies. Pervasive means that it has impact on the entire set of processes or controls or financial statements. So few considerations are ineffective control environment. So if tone at the top, if the risk profile of the company is high, then that can be one of the considerations that there can be a pervasive deficiency. If there are ineffective IT controls or there are issues with the information system of the company, that can be another consideration. If there are pervasive lack of segregation of duties and there are no appropriate alternative controls, that can be again one example that there can be pervasive deficiencies. And last but not the least, if there are frequent management override of controls, then that can be another indicator that there can be pervasive deficiencies. And these more likely than not will trigger material weakness over the company's IFC, and one will have to evaluate that in detail. Compensating controls, although I have mentioned, but to reiterate, those should address the same risk of material misstatement as the deficient control, and those should operate at a level of precision, at same level of precision. Because otherwise, it will not be prudent to say that those are compensating controls based on which we can take comfort. Aggregation of control deficiencies. So aggregation, for that purpose, one should consider significant accounts or disclosures, relevant assertions, aggregation by business unit, aggregation by business process, etc. And it's very, very important for us to understand the root cause of each control deficiency, right? Because if we don't understand the root cause, then we will not be able to do a prudent aggregation of multiple control deficiencies. Summary of adjusted differences or summary of unadjusted differences. If there are findings, then we will have to accordingly evaluate if there are indications of significant deficiencies or material weaknesses in the company's IFCFR, right? So, because those can accordingly indicate deficiencies, and those can also indicate management bias in making any accounting estimates. And also, those can indicate, maybe a fraud or management override of controls. And accordingly, very, very important to consider these factors. Now coming to off-the-shelf package, why I thought it's very important to cover this is because we don't always look at large companies. There are many small companies also which are subjected to IFCFR, of course, based on the limit which is defined in the guidance note. For companies which are not very large and which are using off-the-shelf packages, it is more likely than not that we will put a higher focus on manual controls as relevant controls, and lesser focus on the IT dependent controls, right? And we will have to consider that, how does management ensure completeness and accuracy of the relevant reports which are considered for the relevant controls. So, important consideration is more reliance on manual controls. Very important to ensure that, how a completeness accuracy ensured of the underlying data which is used for the relevant controls. Now, coming to reliance on service organizations. What kind of activities, generally are outsourced to service organizations by a user entity? Because many organizations use service organizations. These are only few examples. There can be many others. For example, it's very common that companies outsource payroll processing, they outsource accounting functions, outsource IT functions. So, as part of this activity, when we are performing the walkthroughs, it's very important for us to consider that which all controls are performed by the entity itself and which all are performed by the service organization. So, why is it relevant? Because if we identify that all key controls are being managed by the company, that is, somebody is performing those activities and somebody is reviewing those, and not by the service organization, then we will not place reliance on the service organization's controls. But vice versa, if there are key controls which are being exercised by the service organization, then we will have to understand that how are those controls being designed by the service organization and how are those operating, right? And we will have to that either that can be done by way, obviously, by way of obtaining a report from the service organization's auditors, because we may not have access to those work papers. So accordingly, we can look at the report of the service organization, auditor's report of the service organization for the activities which are designed and operating in the service organization, so as to be able to conclude that those are designed appropriately and operating effectively. Now, again, I will take a pause of 10 seconds before moving to the last section, which is section 4, which I will try to cover in 10 to 15 minutes. So, briefly, we have covered off-the-shelf package in the previous slide, but here we will cover in detail IT implications and some other important considerations like when do we use the work of others, subsequent events, and how do we communicate certain matters in a IFCFR audit. And then we will wrap it up before we can take our questions. Now, IT, as we said, is a very important element in the audit of ICFR. IT general controls, what are IT general controls? These are policies and procedures that relate to many applications and support the effective functioning of application controls. So, again, a very heavy statement. But what are the examples? These are like, for example, program change, user access, application system acquisition, data maintenance. So ITGCs are controls that maintain the integrity of information and security of data, right? So if a company is, for example, using SAP, so ITGCs will mean that how is the company accordingly ensuring that the integrity of data is maintained and data is secure. That will be tested by way of testing of IT general controls. And effective ITGCs will ensure that there is continued operation of application controls and automated accounting procedures. If ITGCs fail, then that will have an impact on our testing of internal financial controls over financial reporting. Because if ITGCs fail, then one will have to place importance on manual controls rather than depending on the automated controls or IT dependent manual controls, right? So, accordingly, it is very, very important to understand, evaluate, and test the IT general controls. Manual application controls, basically, how do you differentiate between manual application control and automated application controls? So manual is that, like for example, if somebody is passing an entry and somebody is reviewing, signing that in a hard copy document, or reviewing a bank reconciliation statement, signing that as part of a paper document, that can be a manual control, right? Automated control is an example that system will prevent a duplicate invoice from getting posted. That can be an example of automated control. So if the ITGC is failing, then we will not be able to accordingly place reliance on the automated control, but we will place reliance on the manual control. Like for example, if automated control is that duplicate invoice cannot be posted, if we do not have a reliance on the system, we will accordingly understand that what manual control is in place to ensure that there are no duplicate invoices being posted, and we will accordingly test that manual control, right? So very important for us to accordingly understand a that what are the relevant applications which are financially significant, and then design testing of ITGCs, and test the operating effectiveness of ITGCs, thereby basis the outcome, design and evaluate and test the manual controls. Now, using work of others, why it is very, very important? Because, there is a mention in the guidance note also, and obviously, there are auditing standards using work of internal auditor, using work of auditors experts, which apply to audit of IFCFR also. And it is very important to note that although there can be situations where we can use work of internal auditor or auditor's expert, but the responsibility of an auditor is not reduced by using the work of internal auditor or auditor's experts, and extent to which auditor may use the work of others will depend on the objectivity of those persons, competence, skills of those persons, and very importantly, it will depend upon the risk of controls being tested. By way of giving an example, like if there are high risk controls, like controls which address the risk of fraud in revenue recognition, then those auditors should test himself or herself rather than placing reliance on the work of others. If there are some low risk controls, like for example, if property, plant, and equipment is not a very complex cycle in a company, then for that, if a auditor wants, the auditor can accordingly place reliance on the work done by other auditors. Having said that, all controls may not be low risk in a property, plant, equipment cycle also. So it will depend upon the risk of the control, right? And very, very important to state that even if the auditor places reliance, it does not, mean that auditor does not have the overall responsibility. So auditor should consider the results of those procedures and accordingly also evaluate that if he or she needs to perform any other additional procedures to be able to opine on the internal financial controls over financial reporting. Now, coming to subsequent events, as we know that we consider subsequent events for financial statement audits. So, having said that, it's also important to consider the subsequent changes in a IFCFR audit as well, right? So we should perform inquiry with the management if there are any changes in IFCFR or other factors which affect IFCFR. We can perform inquiry, we can look at underlying data, we can take management representations. We should look at, like, for example, any internal audit reports issued during the subsequent period. any other regulators reports issued on the company's IFCFR, and any other experts engaged by the company, we should look at their reports to be able to take comfort if there are any subsequent events which need to be considered by us. So, important element that we covered earlier in the initial slide is that both financial statement audit and IFCFR audit go hand in hand. So, that analogy applies here as well. That SA 560 equally applies to a IFCFR audit as it applies to a financial statement audit. And if an auditor notices that there are subsequent events which are materially and adversely affecting IFCFR, then auditor should accordingly consider implications on the IFCFR report. And if they are not able to determine the effect of subsequent events, then accordingly consider even a disclaimer of opinion on the IFCFR. These are very important considerations. If a subsequent event arises subsequent to the date of assessment, but prior to the date of issuance of report, so then the auditor has to consider that impact also on the IFCFR report. And there may be explanatory paragraph describing the event and its effects on the auditor's report. Subsequent events arising after issuance of a report on IFCFR. In that case, the auditor should discuss the matter with the management and evaluate the impact of those conditions on the audit opinion on IFCFR. Where appropriate, should also discuss with those charged with governance. Now, in terms of communicating matters, we have discussed about the fact that, we have to accordingly during our audit and, at the end, summarize all deficiencies. So all control deficiencies, we have to communicate in writing with the management. We can do that by way of preparing internal control memorandum in which we have to summarize all observations, take management comments on those observations, and reporting to those charged with governance, what we call TCWG, is not mandatory in case of control deficiencies. If there are any significant deficiencies or material weaknesses, then we have to communicate in writing to both management and TCWG, right? And we have to accordingly follow principles of SA 260 and SA 265 in terms of incorporating management's response and communicating with TCWG, right? So, before we come to questions, I would like to summarize what we have covered today. We have covered all key elements of the audit of internal financial controls over financial reporting. These important considerations are to be considered by A, auditors, by B, management, while testing the management's performing management testing of controls as well. We have covered important elements of guidance note. We have understood the 5 phases of planning and audit of internal financial controls. We have understood how both internal financial controls audit and financial statement audit are integrated. We have understood key concepts like entity level controls, the fact that what are 3 types of entity level controls, whether we have to test ELCs or not. We have understood what are BPRs. We have understood by way of examples review type controls and some key considerations in review type controls. For more details, you can refer to examples in the guidance note as well. We have understood key elements of IT audit, understanding the financially significant applications, how it is important to design and operate effectively, the ITGCs, and what comfort it gives on the IFCFR audit. We have understood, off-the-shelf packages, how do those differentiate with large companies. We've understood the key aspects of using service organizations, using the report of other auditors, subsequent events, how those need to be considered in audit of IFCFR, and we have also understood how do we communicate deficiencies to management and TCWG. So with that, I will come to the end of my presentation, and I will request Paris to bring up the questions, and I will try to answer those to the extent possible. If there are any which I can't answer, then we will park those and we will come back to you. Thank you.
So thank you so much, Sonika ji, for sharing your expertise and providing such a deep dive into this particular topic. So I have received few questions. So let's discuss. So first question is regarding whether the same rules which we have discussed apply to bank as well.
So generally, because guidance note principles will apply when we are doing walkthroughs and operating effectiveness of testing. But as I said, you will have to understand in detail processes, significant accounts which are relevant for a bank, and accordingly design your audit of IFC for a bank. It will be very, very different, for example, of doing IFC audit in a manufacturing client vis-a-vis a bank.
Correct.
And accordingly, one will have to consider.
And what about foreign companies? Is the auditor is required to issue IFC report regarding foreign companies as well?
So this guidance note will not apply to foreign companies. It's on companies in India. So if auditor is doing, audit of companies in India, their subsidiaries, then those will be applicable, not foreign companies. Because if you do audits in, like for example, US, etc., if those are integrated audits, then obviously those will apply. But this guidance note will not necessarily apply to a foreign company.
Okay. So could you please provide insights on components of COSO as well?
So COSO, I briefly alluded to those, but I can cover that control environment. Control environment, is a key element of entity level control. So one will have to understand the control environment. Examples are code of conduct, internal audit, audit committee, etc. Then it has information and communication. I briefly covered that. One will have to understand what all ERPs that the company uses, how does information flow, etc. Monitoring of controls, that is how does monitoring happen in a company. Risk assessment, risk assessment, we covered that, those elements during our discussion today. And control activities. Control activities operate at the transaction level, like for example, at revenue receivables, procurement, to pay, purchase payable, etc. Those are key components of a COSO, basically.
Okay. So my next question is regarding consolidated financial statements. So how should auditor of a parent company provide its opinion on IFC over consolidated financial statements when auditor of subsidiary has not issued IFC report, since it was not applicable on that particular subsidiary company? So how auditor should deal with such kind of situation?
So if auditor has to first consider that on which all subsidiaries is IFC applicable.
Right.
And B, auditor will have to consider the controls which are operating at the consolidated level, like for example, for consolidation, etc., by the company. So basis that, the auditor will be able to opine on the consolidated IFC. Auditor is not expected to perform IFC testing of the subsidiaries which are not in scope for IFC.
Right. So whether auditor should mention in its audit report that this particular subsidiary has been consolidated in the holding company and the IFC was not applicable on this particular subsidiary company.
Suitable language is accordingly drafted. Like for example, if there are some companies which are foreign entities also on which IFC is not applicable, we accordingly mention that IFC is not applicable. So in this case also, one can bring to the attention that IFC is not applicable.
Okay. My another question is regarding the non-compliance of any particular India. Suppose an auditor has qualified any particular caption, let's assume revenue, which is required to be recognized as per India's 115. So whether the IFC report should also be qualified with respect to this particular item or not?
So if there is a non-compliance with 115, so a company during its process will have to ensure compliance with the applicable regulations and the standards also. So here, monitoring of control is a key element which indicates that it is not operating effectively and designed properly, right? So accordingly, it does not tantamount to directly a qualification, but one will have to consider implications on the IFC audit also, and see that if it is a controlled, obviously more likely than not revenue will be very material. So
Right.
if somebody is qualifying a financial statement audit, more likely than not it will be at least a significant deficiency in a
Hmm.
IFC report also. So accordingly both will have to be considered.
And let's assume instead of issuing a qualified report, the auditor has issued EUM paragraph in its main report. So how should auditor deal with such situation regarding the IFC report?
So EOM also will accordingly, tantamount to the fact that auditors should consider that whether it indicates any deficiency, right? So
Mm-hmm.
whether it is a EOM or a qualification, so one will have to consider a deficiency. EOM can also mean that there might still be a more than a control deficiency in a IFC, right? So or it may be a situation that it does not result in a significant deficiency or a material weakness, but what I'm trying to say is that auditors should consider, what is the implication on the IFC report, even basis a EOM paragraph.
Okay. My next question is whether an auditor need to check all transactions each year, or will it suffice a few transactions are verified in depth in 1 year at the start of an audit term?
So here, what I would try to, understanding and evaluation is, which is a walkthrough has to be performed every year,
Mm-hmm.
so as to be able to understand that if a process has changed
Mm-hmm.
during the year. Uh, there is also a guidance on rotation of controls in the guidance note. So if we are auditors since last couple of years, and nothing has changed in the process, then we can accordingly apply a rotation of controls guidance, but that is generally not applied on cycles which are high risk cycles. So on low risk cycles and low risk controls, one can accordingly apply rotation of controls guidance. But understanding and evaluation has to be done to ensure that nothing has changed. And then rotation of controls can be done, accordingly one can test, on a rotation basis. But generally, as a practice, it's very prudent that, if you are auditing only since last couple of years, generally it's prudent to test every control. And only when you have enough comfort on that particular entity's controls, then it is prudent to accordingly apply rotation of controls guidance.
Correct. Next question is how ICFR is different from IFC?
So it is here we call it internal financial controls over financial reporting. That is controls which are relevant for financial reporting only, right?
Right.
So as part of our understanding and evaluation, there can be controls which we see are operating controls, right?
Hmm.
Those may not be relevant for financial reporting, and accordingly we do not test those controls, and accordingly it is called internal financial controls over financial reporting. So we have to consider financial controls rather
Okay.
than internal controls over financial reporting.
Okay. Next question, are there any reporting considerations from ICFR audit perspective in case the statutory audit is accepted after the balance sheet date?
So if it is accepted after the balance sheet date,
But before the signing of the financial statements.
before the signing of the financial statements, auditors otherwise can still perform walkthroughs and test the controls. What is important is that management should have all documentation in place The controls should be exercised during the year by the management. Auditors can still, go after the balance sheet date and test. But the problem will be that if there are any deficiencies, then there will be no time for remediation. So if suppose there are deficiencies noted, if we discuss with the management, they will have no time for remediation because it is already post facto, right? So then those can be addressed only in the next year's audit. If there are no deficiencies, we can still perform, but deficiencies, it will be a problem because we can't go back to a audit period and accordingly address those. So that will be there.
Okay. My last question is that in case of group audit, which is following the calendar year, and the statutory audit, which is following the financial year, means, so what is happening here? I think in the case of holding company is following the calendar year, because globally we follow the calendar year as financial year, and one of the companies in India which is following financial year with effect from 1st of April, right? So the participant is asking, we are taking 3 months ICFR samples proportional for testing. Whether 9 months sample testing used for both audit, whether our understanding is fine in this regard.
So if I'm, basically what we have to do is that for the 12 months in the financial year, depending upon the frequency and the risk of the control, we have to test samples. Like for example, if there are multiple times a day control, and if it's a low risk control, assuming that, if we have to test 25 samples, we have to spread our testing throughout the year, which is April to March. If April to December, if we have covered, say, 20 samples, if we have covered 5 in January to March, that is also sufficient.
Correct.
But we have to cover throughout the year. We can't say that, if we have covered only 25 within April to December, we don't cover anything in January to March. Is that sufficient? Answer is no. So we have to very importantly cover throughout the year. We can cover 20 and 5 in my example, and that will be sufficient.
Okay, so this is it from my side. Thank you so much for a wonderful session. And Anilji, are you there?
Thank you so much. Can you hear me, sir?
Yes, we
Yes,
can
yes.
hear.
Due to the technical glitch, video is not working, sir.
No
So
worries,
thank you
sir.
so much, Sonika ma'am, for such a wonderful deliberation. It was wonderful session, and the insights you have shared with all the members, it was wonderful. You have covered all the aspects relating to the topic. So on behalf of AASB of ICI, I extend my heartiest thanks towards you for sharing your in-depth knowledge as well as insights towards our members. Hope our members have gained a lot through your deliberation, ma'am. Thank you so much once again. In
Thank
spite
you
of
very
having
much.
busy schedule, you have given your kind consent to deliberate for our members. Thank you so much once again.
Thank
And
you
I
to
also
all
thanks.
for a patient listening, and have a good weekend, all of you. I hope I have, answered your questions. If there are
Yes,
any
ma'am.
other
Yes, ma'am.
questions, you can share with Anilji and his team, and
Yes,
I'll be.
sure, sure, sure. I'll forward it to
Thank you very
you.
much.
And I also thanks towards Paras Chatterjee for giving his consent to wonderfully moderating the today's
Thank
webinar.
you
Thank
so
you
much,
so
sir.
much, Paras ji,
Thank you,
for
Paras. Thank you.
thank you so much.
Thanks.
I also thanks all the participants of today's webinar. Thank you so much, everyone. Thank you so much. Namaste. Good evening.
Thank you.
Thanks, everyone. Bye.
Thank you.